Hello, our final project is Le Petit Crips, and our team is José Ernesto Temoltzin, Diego Vazquez, Emmanuel Soto, and me, Ricardo Romero. Well, our investment project description. We are going to build a company that is called Le Petit Crips, and the future location will be nearby the Anáhuac University here in Puebla. In the market research, the crepes are originate from a region in France where they are called crampo Vazquez, and they are consumed daily in that country. For the market research, we proceed to develop a 8-question survey in the university here in Anáhuac, Puebla, and the half of the respondents were men and half were women. And the conclusions of that market research was that half of the respondents, like I said, were women and men, and the most were young, and the most of the respondents eat crepes at least once a week, and all the respondents would like a crepe truck nearby the university.
So here we have our project structure. We determine our price of our 5 products, that will be our crepe with Nutella, crepe with Philadelphia, self-made crepe, and 2 frappes. So we determine those prices in base of our price competition and also on the social status of the university. Also, here we have our daily sales for our 5 products. So we have to sell 15 products each day, leaving us with 865 products of each by each year. In this table, we have our direct labor cost and our direct labor materials. As we can see, making a crepe is it's cheap, so we will have a lot of marginal revenues. Also, we determine a growth rate of units of 7% each year, a growth rate of cost it will be 8% each year, and a growth rate of prices that will be 5% each year. Here we have our new equipment cost, our delivery and installations, the digital register cost, our food truck, all the adaptations and permits that we will need to do to start working in our food truck. For our revenue budget, in this table we can see our 3 crepes, and with the units we have here, we multiply it by the price, so we get the revenues. In this case, with the crepe with Nutella, we can see that we have an increase in the units per year and an increase in the price per year. So our revenues will be increasing each year. In this second table, we have the same, but focus on the frappes with the mocha and frappe with the caramello. So we also have the increase in units and the increase in price. For the expense budget, we determine our variable cost per unit, that we can see also that it is growing each year, multiplied by the units. So we have a total variable cost of product in the case of the crepes with 7,485 pesos in the first year, and we will see an increase in the following 10 years. Here we have the same thing, but with the frappes, and also the total cost of and expenses when taking into account the total variable cost and the administrative expenses. We have a total cost and expenses of 175 in the first year, and we see how this cost is increasing by each year for the following 10 years.
Now we have the depreciation. In this case, we depreciate 3 elements: the food truck, the equipment, and the computer, but with different amounts. The food truck will be depreciated over the half of the accumulated depreciation, that is just 15%, and then the equipment we depreciated over 100, and the computer, it's different because we have 4 years just, and it's different, the depreciation for the computer. And then we have the total amount of the depreciation in every year. Now for the net investment, we define the total cost of the food truck, that are the sum of the cost of the food truck and the adaptation we are making to this. Then we define the cost of the equipment that you can see in the other table. That are the 2 crepe maker, blender, sink, fridge, utensils, card reader, cash box, regulator, the internet, decoration, light, and painting. After that, we define the delivery and installation cost. That gives us the total cost of the equipment. Also, we sum the cost of the computer, then the networking capital, the permits, and the training, and that's how we got the total of the net investment. Then in this table, we can see how we got the net cash flow. We have the revenues, it's subtracted by the expenses and depreciation. We got the earning before taxes. Then we define the taxes, and that are defined by the ESR here in Mexico. We subtract that, and we got the earning after taxes. Then we sum the depreciation, the net working capital, and then we have the net cash flow for every year. That the 10-year is different because we also have to take in account the recovery of the net working capital, the income from the sale of the asset, the tax effect, and then we have the terminal net cash flow. Now to take out the WACC, or the weighted average cost of capital, we define that in the following tables, we can see that we are asking for a loan for the bank A and B. But in the bank number 1, we just have 10,000 of the equity, the debt. And in the bank B, we have the rest of the money. And then we calculate the KD because of the percentage of the loan in every bank. We have a percentage of 16. Then to take out the K of equity, we sum the inflation, and to take out the debt, we subtract the ISR tax rate. Now for the evaluation techniques we are using, we determine the present value that we are having because of the annual net cash flows. That gives us the number we can see there, and then we have the payback and the discounted payback. For the payback, we have a result of 3 years, and for the discounted payback, we have 4 years. That we can see in the table, and when we have a positive number in the payback, and then in the discounted payback, that's how we got the years. After that, we also have to calculate the profitability index, that is with the formula we can see there in the screen. Then we have the internal rate of return, we take into account the annual net cash flows, and different for the modified internal rate of return, we take into account the WACC, and also the reinvestment rate, we define 8% for this case. And here we can see the results of every thing we calculate. For the profitability index, we have a result of 3 pesos. For the internal rate of return, we have a percentage of 45. And for the modified internal rate of return, we have a percentage of 26%.
Now to to evaluate the risk of the project, we made 3 cases. Well, exactly 2 cases and the base case. For the best scenario, we consider a unit growth of 20%, a reduction of the cost growth of 20%, and a prices growth of 20%. For the base case, we stay with the previous data that my partners already told: a unit growth of 20%, a cost growth of 8.50%, and a prices growth of 5%. And last, for the worst case scenario, we had a reduction on the unit growth of 20%, a cost increasement of 20% and a price decrease of also 20%. So we define the probabilities of these cases to happen. For the base case, we had a more likely chance of 50% because it's how the market is currently heading. For the best case, we had a probability of 25, and for the worst, also 25. So with this, we calculated the expected net present value. But before this, we calculated the net present value of each case, and we multiply the probabilities times this value. And at the end, when we sum it, we have a expected net present value of more than 1,008,000 pesos. Now, for the financial risk, to continue with this, with the previous information, we determined the variance and the standard deviation so we can calculate the probability of having a negative net present value and a positive net present value. So first we calculate the variance, and then after this, with the formulas of Excel, we calculate the standard deviation when we obtain a value of more than 3 million. And after this, we obtain the value of C, which has a value of 0.5774. And with a binomial distribution, we have a probability of having a net present value of 28.31% and a probability of having a positive net present value of 71.69%. Now for the sensitivity analysis to determine how a change in the growth of units, cost, and price, and the WACC could affect the net present value of the business. So we took into account 4 scenarios with a decreasement in each variable that I mentioned before. First, of a decreasement of 20% and 10%, and then an increasement of 10% and 20%. And as we can see in the chart below, we can observe that the net present value is more sensitive to the price change, but it's less sensitive to the unit change, as we can see that the unit graph doesn't increase that much. And the net present value is also middle sensitive to the cost, to the change of the cost. And for the WACC, we can see that it behaves the same as the cost by not being so much sensitive to it. So as a result of all the valuation techniques, we have a net present value greater than 0. So this is a good notice. Also, the modified internal rate of return and the internal rate of return are greater than 0. And also these are huge percentages. So this is a good sign. And also the discounted payback and the payback are from low years. Let's remember that this project is for 10 years. So the less the years we recover the investment is better. And last but not least, the profitability index is more than 1 peso. We tripled this profitability index with 3.03 pesos. So in conclusion, we consider that the net present value is as I said before, is good, is a huge amount, and the evaluation criteria is also good for the whole evaluation techniques. So we can say that this is a good project. Also, the discounted payback and payback are a little high, considering that these results are for 4 and 3 years respectively, but we still think that this is a good result. Also, the internal rate of return, we think that this should be higher. We should be greater than the WACC, and the MIR should be the same. So in this section, the acceptance criteria are met at the end of 10 years. And finally, for the profitability index, this must be greater than 1 peso. And in our project, it gives us 3.3. So this is a really good sign, as I said before. And we have for each peso that we invest, we will have a return of 3.03. So the recommendations that if we want to invest in this project is that they should know that this is small and has a small cash flow. So also at the end of the 10 years, you will have positive standards, it will not generate a great amount of profit for the investors. Thank you very much.